Hello everyone, good afternoon and welcome to my latest webinar for this technical analysis series that I've been doing over the last few weeks, and this latest one is on Bollinger Band. Basically we're going to talk about volatility today, and volatility, if you've been looking at the markets today, is one thing that the markets are engaged in, so it could be a lot to talk about, and hopefully we'll have a look at the markets and see what they're doing. But first of all, starting off with my disclaimer as per usual. A little bit of a risk warning for you, so just read that at your leisure. I'm going to show it again towards the end, so hopefully you will just have a read and understand of that, and it'll be nice for me. Okay, there's my biog as well. Just by now I'm hoping you've sort of realised that I am pretty much am qualified to speak about technical analysis and market moves, and I'm hoping that you have, to a certain extent, believing what I say. Anyway, onto the agenda. Now, for today, we're going to do, as per usual, a little bit of theory on Bollinger Bands. Then we're going to see the different uses of Bollinger Bands in different markets, again, as per usual, and some signals that you get with the bands. You can get breakouts and reversals. And we're going to do some live market analysis at the end, and there is a hell of a lot to talk about, so I'm going to try and get through Bollinger Bands as quickly as I can in terms of the theory, and then get on to a little bit of practice so you can see what's going on. Right, okay, so Bollinger Bands. Bollinger Bands are basically one of the more mathematical technical indicators that we look at, and basically it just brings into technicals the concept of standard deviation, which is very much a mathematical concept. And we talk about volatility. Now, standard deviations, I've got a bell curve here. Anyone who can remember their maths that they took at school would have looked at bell curves, and distribution around a mean, which is gives us our bell curve. And basically, it's all to do with standard deviations around that mean. And Bollinger Bands are pretty much the same sort of thing. They basically use a moving average and calculate standard deviations around that moving average to basically encompass the price action that we're seeing. Now, as you can see on this bell curve chart here, 95.4% of price action theoretically should stand between the two standard deviation limit on the bell curve. And if you're going to go even more tight than that, then 3 standard deviations is 99.7. So that's how we look at standard deviations, and Bollinger Bands use standard deviations to encompass price action, and basically to try and work out excessive moves within the market. So that's how we go there. Now, Bollinger Bands, basically they form an envelope around a moving average, as I said, and the extreme levels are where you get your signals, and I will show you through that in a bit. Now, what do they show you? They show you basically where the price is relative to the recent history, and also where volatility is relative to recent history as well. So basically we're looking for the danger signs and sort of periods of high risk that you get from those extreme moves. What they don't show you, however, and I stress this, is that they don't give you absolute buy and sell signals. You need to be using Bollinger Bands in conjunction with other technical indicators in order to give you the confirmation, because Bollinger Bands, in theory, don't give you absolute buy signals or sell signals. Right, so next one. Okay, so in terms of changing the parameters, now what I'm going to do now is show you your first chart, because there is a Bollinger Band, and I talked about envelopes because basically an envelope is a different way of forming a band around the price action. Now, the Bollinger Band is the red one at the top. That uses this 2 standard deviation Bollinger Band around a 20-day moving average. Now, you can also use price envelopes as well. Price envelopes are basically just use percentage moves around again around a mean, and that mean in this instance I've used again 20-day moving average. Just for your information, the 20-day moving average 2 standard deviation is the theoretical norm for Bollinger Bands. It's basically what John Bollinger, who invented Bollinger Bands, uses, and that's why they are that's the most popular way of using them. So yeah, so you can alternatively use a percentage envelope around a moving average, but as you can see here, the price action is not contained often within the percentage envelope. Now I've used a 1% envelope here. You can change that. You can do whatever you think is best for this for that move. However, as you can see, it's fairly uniform in terms of its movement. Because it moves around a moving average, it doesn't reflect the volatility, which is what Bollinger Bands do, and which is why a lot of traders use Bollinger Bands over things like percentage envelopes. Volatility is obviously the key element in Bollinger Bands, and volatility is not taken into account in percentage envelopes. So that's why I prefer Bollinger Bands. Anyway. Okay, so there are different ways, as ever, there are different ways to look at Bollinger Bands. You can change the parameters for both the moving average calculation and also the standard deviations. You can change the moving averages. For example, if you went to a 50-day moving average from a 20-day moving average, it would be much less volatility, much more of a smooth band, and therefore a lot more price action would be taken into account because the bands effectively widen, and therefore subsequently you get less trading signals. Now, as per usual, if you tighten the parameters, you'll end up getting a lot more signals, but the propensity is for more false signals. So the normal way of changing Bollinger Bands is to change the standard deviations. I've got here the statistical analysis for 1, 2, and 3 standard deviations, which is 68% of the price action, 95% and 99% of the price action. And I've got a chart that shows you that. Okay, so we've got here the three Bollinger Bands around a 20-day moving average. As you can see, 1, 2, and 3 standard deviations encompass different amounts of price action pretty much across the board. 3 standard deviations encompasses all the price action, and that's statistically, as I said, because it's just around 99% of the price action. I think if you are going to change it, a lot of people use maybe, say, 1.5 if you're going to tighten it. So let's change that 1.5. It just slightly widens it, and the other way to do it on the other side would be for changing the 3 to a 2.5. Again, that slightly tightens it. So you get an idea that basically by changing these Bollinger Bands, you can get different signals and encompass more price action. So that is one way of doing it. Okay, so what are we looking at in terms of our signals? Well, just a quick sort of summary, really. Basically, on Bollinger Bands, you're looking at the bands to either widen or narrow, and wide Bollinger Bands suggests periods of high volatility, strong price action in one direction or the other, and what we're seeing is when the bands become narrow, that suggests that the standard deviations, the standard deviation around the moving average is sort of decreasing, and we get lower volatility, and that suggests consolidation or tight price action. Now, you've got here sort of this example chart here where you've got this strong trend, and the bands are quite wide apart, and then when the price moves into consolidation, the bands tighten. Now, it's movement away from that, away from those periods of tight trading, trading bands, that you get the best signals, and I will focus on that in a little bit later. Right, so you've got four basic concepts or principles with Bollinger Bands, and I stress once again that you can basically you're dependent on confirmation from other technical signals or technical indicators to derive what you actually get out of your Bollinger Bands. So there are fairly strong signals you can get from Bollinger Bands, but they can be negated by other technical indicators, so you need to be aware of that. Now, okay, so the first one, prices hitting the upper or the lower band can be considered to be either continuation or reversal. Now, it entirely depends on how other technical indicators are looking, because if you get a confirmation of the strength or weakness in the move, then that can suggest a confirmation of a continuation. And if you don't get the confirmation of that strength or weakness, it can actually signal a reversal, i.e. sort of a range-based trade. Okay, so for the second one, you've got tops and bottoms that are posted outside the bands, followed by a second top or bottom within the side of the bands, within the bands, signal a trend reversal. Now, this sort of ties in with a concept I'm going to talk about in a bit called reversals, and I will. That's our first trading signal that you can get from Bollinger Bands. Okay, so number 3, move originated at one Bollinger Band tends to move towards the other band. Now, again, this is sort of dependent on the direction of the trend. If it's, say, for example, a sideways trend, then it's best that you play the range within that sideways trend, and the Bollinger Bands can be very good at calling that range. And finally, number 4, we're going to talk about the fact that sharp moves will often be seen as the bands narrow. Now, again, this is I believe this is probably the best signal that you get with Bollinger Bands, and it's sort of the concept of breakouts. Okay, so first of all, on reversals. Now, this is sort of akin to the second point I was talking about. Basically, we're looking for reversals when you get narrow bands, and you get, which suggests high volatility, and then you're looking for a close or an entire period outside those bands, which suggests an extreme move and extreme volatility. And when you get extreme volatility, you're therefore at risk of a reversal, and that reversal is then sort of added to in terms of what we're looking at from the next period, which is then comes back inside the trading bands. So that's sort of what you're looking for. You're looking for an entire trading period or day outside the bands, and then a move back inside the bands for a sort of suggestion of a rejection of that initial move. So that with that extreme move, we're then seeing a reversal, and that tends to work pretty well, actually. So yeah, it tends to work pretty well. So you're basically so it basically sort of signifies a danger or an extreme move, and the chances are you're then going to get the next period inside the bands. Now, I've got a chart that can help you see this. Okay, so this is FTSE actually back in March, where we've got basically just wanging around all over the place, wide Bollinger Bands suggesting highly volatile, and that was exactly the case back in March. And we had a move that came outside the Bollinger Bands and subsequently moved back inside it. And as I said, it actually can often work best with a confirmation of a second low that comes inside the bands, and that is what you're seeing here. You've got your second low inside the bands, and then you get a move that goes from one band up towards the next band, and this one on FTSE worked very well in this instance. Okay, so on the other side, again, this is dollar yen. Actually quite a while ago, June 2009, but still it worked very well. You've got again volatile market with the bands quite wide apart. You've had a strong move. You've got an entire trading session outside the bands, and then you get a reversal back inside the bands, and sort of again sort of a second high inside the bands. But the fact is that you've had this sharp move, and it is that sharp move in this instance was effectively counter trend as well. So it's sort of that would have been given you a great signal, and ultimately it was a very good signal. And I'd only just noticed this about 20 minutes ago, but there's another one here as well, that you've got the bands wide apart again counter trend. Interesting, where you get, to all intents and purposes, you got a whole trading period outside the bands, and then subsequently you were back inside the bands as well. So then you push back towards the opposite band. So yeah, those ones on Dolly N worked very well. Right, range trading. Now, range trading basically works when you've got flat bands. So you're looking for flat Bollinger Bands that are not really going anywhere, and would suggest sideways trending market. And what you're basically effectively doing is just looking to play the bands. So you play the range with the bands. When you hit one band, the expectation is that you will then push back towards the other band, basically because you're not looking for any extreme move. Is unlikely to continue in this big ranging scenario, and then you can just play high and low, buying at the low, selling at the high, and using the bands effectively in that scenario. And we've got again dollar yen. Come on, where's my mouse? There you go. Dollar yen. Okay, dollar yen back from 2012. This is basically where, okay, now I've had a question that's sort of is asking me about how you know when you're in a ranging phase. Well, again, you're sort of looking at other technical indicators, and in dollar yen in this environment, we've had this, for example, back in March 2012, we've had this big downtrend going on. Then you've broken that downtrend, and then you've started to look to push higher. However, you've then started to find resistance around the old highs and those lows there. So you've then hit resistance. So at that point of hitting resistance, which is also at the extreme point in the bands, you then start to think, okay, well, maybe we're entering into a bit of a ranging period. The bands are basically going sideways anyway. So you're looking to think, okay, well, maybe we're trading in a sideways band, so I can use the Bollinger Bands to sell at the hot top and buy towards the lows again. And pretty much it did work very well throughout this period. This 3-4 month period, you would have done rather well. I mean, okay, the only time maybe you wouldn't have done especially well would have been around here in mid-July, but even then you would have had a chance to get out ultimately. And yes, the move did work very well. So you can play the highs and the lows within the bands each and every time, pretty much to the letter. And even then, here, when you started to think about breaking out, it didn't. Again, it hit the resistance of that 80 spot 60 level, and then came back. And the end of that range phase comes with the breakout on that strong move on the upside, and that is when I believe you would have stopped playing that move because of the end of that sideways trend. Okay, so onto trending markets. So instead of your sideways trending markets, you've now entered into a strong uptrend or a strong downtrend, and you have to use the Bollinger Bands in a different way. Basically, in a strong trending environment, as you can see in this sort of diagram that I've got here, your Bollinger Bands are used as a trend tool. So you want to be trading in the direction of the trend, and I can't even imagine how many times I've told you that over the past few weeks. You've got to be trading in the direction of the trend. That is one of the fundamental basics of technical analysis, in my opinion. The way that is the best way to lose money in technical analysis is to trade counter trend, and to so for example, shorting in an uptrend and going long into a downtrend. That is the best way of of losing money, in my opinion, because it's a very high risk move. So what are we looking at with Bollinger Bands here? But in this scenario, in a strong trend, you're likely to get the price action to be in the upper portion of the Bollinger Bands. So therefore, you look to use any sort of move back towards the moving average, or just below the moving average towards the bottom half of the band, as one of two things: either you're looking for buy signals at that stage, or the suggestion is that you are at high risk in your short positions. Your short positions in this instance, and I stress the fact that in my opinion, going short into an uptrend is a risky game. But if you are short in an uptrend and you've got a move back towards the bottom Bollinger Band in a strong uptrend, you should be realizing that you are now at high risk of a recovery and a rally. So that would be your alarm signal to possibly take your profit, or to come out of that short position. Because ultimately, in this strong trending environment, in the uptrend, you are likely to resume that uptrend in due course. And I've got one to show you. This is dollar yen, actually at the end of that sideways trading period that we talked about earlier. We've got dollar yen that moves sideways and then subsequently breaks higher. So you're looking for the price action to then start hugging this upper Bollinger Band, and it does it pretty much all the way. And then even then, you use any move back towards the moving average, or even into the bottom half of the band as a chance to buy, because you're continuing to use the strong trend, and it goes all the way until you actually start to have a breakdown of that lower band. You actually get a whole period outside down the bottom. So that actually that sort of signaled the end of that trending scenario there on dollar yen. Okay, so the opposite of that is your downtrend. Again, you're looking for price action to remain majority in the lower half of the bands. Again, you're looking for any sort of move into the upper half of the band is a chance to sell, because you're looking for short trading in a downtrend, because as I said earlier, you're trading with the trend, and within that argument, you would also then see that any sort of move towards the upper portion of the bands would be seen as a high risk in your long positions. Your long positions are subsequently at high risk of being reversed. So I have a chart to show you that. In Eurodollar, here we go, Eurodollar currently. You've been trading sideways through the summer, through the early half of the year, and you subsequently break down on Eurodollar. So you've broken that key support that came at 34.75. You've broken that support, and you subsequently start to engage in a big downtrend. Now, the big question is, look at today's move. What an incredible move we've had today, actually. It's incredible. 260 ticks, that is. Wow. That's huge. Anyway, of the daily trend, of the daily trading range. Now, that is certainly still actually within the Bollinger Bands. There's no real reason why that sharp move higher is not again a chance to sell as per Bollinger Bands. I'd stress that you'd be looking at other technical indicators just to give you confirmation of that, and I'm still personally of the opinion that you would still be looking at a rebound in dollar yen as a chance to sell. That's just that's my outlook. And yeah, today it looks like it has been another chance to sell potentially. So one to think about there. But throughout this whole period on the downside, in this big strong downtrend, the price action pretty much hugged the Bollinger Band all the way down, only occasionally coming off to sort of come back towards that moving average, but then came back towards that Bollinger Band on the low side again. So interesting, strong move there. And your final Bollinger Band signal that we get, and I think it's the best signal that you get off Bollinger Bands in isolation, and I stress you shouldn't really be using Bollinger Bands in isolation, but if you were forced to, then I think this is the best one, because you're basically looking for tight Bollinger Bands, or narrow or pinched Bollinger Bands, I suppose. And the concept goes that in a breakout, you're looking for these tight Bollinger Bands to explode outwards again, basically because periods of low volatility don't carry on for very long quite often. Certainly in highly liquid markets, you will often see that any sort of period of low volatility will subsequently result in a big burst of price action, with the Bollinger Bands sort of widening significantly. And in that scenario, you want to be in that move that suggests an end to the low volatility and approaching high volatility. So you're looking for your Bollinger Bands to tighten significantly, and then you're looking for a close above. This is in a bullish signal, a close above the Bollinger Bands. Now that would be helped by a second close above. Once that happens, the Bollinger Bands will start to move apart, suggesting high volatility or increasing volatility, and increasing volatility subsequently should result in further strong move to, in the case of the bullish signal, the upside. In the case of the bearish signal, you're looking for a close below the tightening Bollinger Bands, and subsequently you basically go with the expanding bands. So let me just show you on the chart. So in this instance, you've had dollar Swiss. Here we go, dollar Swiss. You've got your Bollinger Bands that have gone quite tight. They've been quite wide. Let's just come out there. They've been quite wide apart. They don't tend to sort of come too narrow. But then in this period here, June into July 2011, they've got quite tight as the market has sort of flattened off. Then you've got your sharp downside move. You'll close outside the bottom of the Bollinger Bands. The Bollinger Bands then start to widen, and you have your second move outside the Bollinger Bands, second close outside them, and you start to think, well, okay, there is something in this, because the Bollinger Bands continue to widen, and you go with the expansion of the Bollinger Bands. So you go with that move to the downside, and subsequently in this instance, that move was very strong to the downside. In the opposite of that, you have dollar CAD. Dollar CAD again. Let me just move there. You've had pretty wide apart Bollinger Bands here, and then they suddenly start to narrow, suddenly start to tighten, and then on that tightening in this part here, you then start to get closes above the bands. And those closes above the bands are your signal, and then with that scenario, the bands start to widen out, and you go with that move. In this instance as well, interesting, you've actually got a second one over here, where you've got the bands that have tightened. You've had that initial run higher, the consolidation has then taken hold, and then you've had your second close above, another close above the bands, and then in that instance you actually get an excellent breakout. That is even better than this one, because you actually get a very strong move to the upside. And then again, you've had your narrow bands that subsequently widen, and you go with the widening, go with the expanding bands, and the volatility just pushes dollar CAD higher. So very strong move there on dollar CAD. Okay, so that's pretty much what we're looking at in dollar CAD. What I'll do now is, oh crikey, wrong one. What I'll do now, that was my platform, is, let me just get that properly, just show you now what the markets are doing. I'll take you quickly through what the Bollinger Bands are saying at the moment with some of these things, because we've had some huge moves. FTSE, starting off with the indices, FTSE, Bollinger Bands, massively wide apart, but there's no real signal that suggests there's any reversal in FTSE. It's still going down. You'd still be playing the Bollinger Bands to the downside, hugging the bands, strong trend. FTSE looks like it's going lower as per Bollinger Band analysis, and I'll have a look at FTSE in a different way in a bit with the other indicators, but certainly according to the Bollinger Bands, FTSE looks pretty negative still. GDAX-I. DAX, same picture, pretty much exactly the same in terms of the Bollinger Bands. Look at that move to the downside, such a strong move, and not even yet really any signals that suggest any turnaround. So further downside in the DAX, according to Bollinger Bands .SPX. Now this would be interesting because it's only just opened. Yes, rebound, interesting. Wow. Yeah, you're still looking pretty extreme. You've actually sort of opened in the bands, but a lot of today is going to be outside the bands unless you get a sharp rebound. But at the moment, it certainly looks like the S&P is still under big pressure to the downside. Christ, yeah, that looks really quite strong to the downside still. So big volatility. Look how wide those bands are apart. So there's no real suggestion yet of any reversal on the Bollinger Bands on SPX. Look at euro dollar now. As I said, you've just rebounded back towards the top band. The only thing that would leave me questioning that is now that the bands are starting to narrow slightly. So maybe you're a little bit cautious about putting on a new short position, but still, I think you'd probably be using other indicators on euro dollar to give you the your overall strategy there. Wow, cable again. That rebound pretty much to that resistance. Look at that. And yeah, I'll talk about that in further detail in a bit. But yeah, nothing really suggesting anything more than further downside on cable on the Bollinger Bands. Certainly, the bands are widening, and it's still hugging the band. No signs of reversal. Very strong move to the downside, it looks like, on the Bollinger Bands. Dollar yen. Wow. Wow, wow, wow. My lord, look at that. 105.20 as the low today on dollar yen. That is incredible. That's just simply a huge move on a one-day basis. Now, we are strongly outside the bands as we're trading, but no real suggestion that move is going to stop, according to the Bollinger Bands. In fact, the Bollinger Bands are widening quite strongly now, so it does look as though that's a big, strong move, and I'll have to look at that in greater detail. Okay, just one more on these Bollinger Bands on the gold. Yeah, interesting. You sort of no real signal there, because you've gone from one band to the other. Now it just depends on, I think, on other technical signals. Because do you remember the point I made about going from one band to the other? It just depends on whether it's a continuation or a reversal. It depends on other signals, and I think in this instance you need to be looking at other trading signals here for gold. Okay, right, let's look at these on a with a lot more indicators. So we're going to start off with euro dollar. That is a very popular one. That is, yeah, I just think it's just very highly volatile at the moment. In terms of trading sessions, we're getting 100 odd pips a day at the moment, and well, obviously today, huge move to the upside, slightly being retraced now as we speak. However, looking at these momentum indicators, you're just unwinding momentum at the moment. But you would also argue that there is further to unwind. Certainly, look at the MACD lines. There is further, and those stochastics have just started to just kissed and sort of moving apart again. So, well, yeah, I'd say there is possibility of further rebound, but I think that Eurodollar is so volatile at the moment that it's going to be all over the place, and I think that it's going to make sort of trading on a multiple day basis. If you're going to trade for more than have a trade on for more than a period of days, I wouldn't like to say exactly where it's going to go. I think you've got to be trading Eurodollar intraday at the moment because it's so volatile. It's showing no real trend at the moment, certainly in the near term, and that will make trading on Eurodollar very difficult. So if I just change that to hourly, maybe we get more of an indication of that. Yeah, look at that move. That's on the hourly chart. Look how overbought it is as well. But, oh no, okay, sorry. Let's try that something different. Okay, there you go. I mean, that is just really, across the course of the last few days, that is just so difficult to trade. Every time you get sort of a suggestion of a trend, it breaks that trend, and you'd argue that it's just effectively just trading in a range, isn't it? I mean, it's sort of trading 127, you'd argue. Certainly across the course of the last week, anyway, 127 towards maybe 120, 128. Sorry, 126. My eyes are gammy. 126 up towards 128. Obviously, we've had that spike today, but I mean, it's been instantly rejected. So, yeah, it's a strong move, but it's been rejected. So it'd be interesting to see how Eurodollar settles down. But it is very difficult, I think, to read Eurodollar at the moment. Obviously, with this high volatility that we're having in terms of just wanging all over the place. GBP. Now, GBP USD, I believe, is a sell into strength, and there's a lot of reasons for that. Consistent downside. Let's just change this back to a daily. Come on, come on, come on. Okay, so, okay, we'll get rid of that. That was a while ago. Right, so just consistent downside on this negative trend. We're still pulling lower. Every rebound has been sold into. Momentum indicators just consistently negative. Look at that RSI consistently just rolling over around as it gets to 40. MACD lines absolutely showing nothing to go on. Stochastics as well. So basically, you'd be using any rebound as a chance to sell. Get rid of that fib. Yeah, I don't like cable at the moment. I think it's certainly going to be coming lower, and I think today will be used as a big selling opportunity on cable. On the hourly chart, yeah, look, I mean that resistance, which is around $1.66, sorry, $1.60, which again is that 50% fib level, which is on the daily chart. Momentum indicators, yeah, I mean, just look at that. Even on the hourly chart, this rally just looks like it's a chance to sell. Again, that RSI coming back towards mid-60s, looks like it's rolling over. MACD line's not even getting above. Stochastics as well, look at that sell signal on the stochastics. So, yeah, I think this is a selling opportunity on cable. I don't trust this rally. I think it's going to come lower. Now, we talked about dollar yen earlier. Look at that move, my lord. Such a strong move. That just suggests that there's been a massive move into safe havens today. And if you look, I know we don't tend to talk about bonds or bond yields, but I know that the US 10-year Treasury is back towards 2% now. It's just a ridiculous move. on the day. It's lost about, I think, yeah, gone from 220 down to like 203, I think it is today. So just an incredible move on dollar on 10-year Treasury yield. And dollar yen, I'll look at gold in a minute. You can almost guarantee gold as well, just massive up day. But yeah, what are we going to do on dollar yen? Well, ultimately, I still think that dollar yen is a medium-term buy. I've been looking for a buy signal. Obviously, we've had this volatile move today. This is on the hourly chart. So unfortunately, we have to go through. Coming back. Yay. Now I have to apologise, this my computer is really slow. Anyway, okay, so we'll try the dollar yen chart again. This is, oh god. Anyway, okay, well, dollar yen, basically I'm looking for medium-term buy signals. Here we go. Medium-term buy signals, you've got arguably the beginnings of one here with the stochastics beginning to turn up. Now the MACD lines have certainly not turned up, and the RSI seems to be still falling. So you're not yet expecting this buy signal. However, this top pattern, well, there is a top pattern there that formed below 108, actually gave us an implied target of 106, and that's obviously been hit today by this spike lower. So that now means that that top pattern has been completed, and we now look for the next signals. Also, look at this over here, this big support low. Pretty much captured that low today, not a million miles away from it. So I'm still of the expectation that dollar yen will be forming some support. Okay, it needs to settle down again, but we have the beginnings of a possible buy signal with these stochastics. If those stochastics start to rise and then turn up and cross back over above 20, now that would be your buy signal on the stochastics. MACD lines also, if they start to settle down, although they are actually accelerating away at the moment, so I think it may be a little bit early to start talking about buy signals and actually going long, but just be aware that I still think that this is a medium-term buy on dollar yen, and I think there is further room for some upside. So I talked about gold a little bit, and there you have it. Now, what you're looking for here, your 1240 spot 60 resistance. That's that medium-term low that we got from June. That is the old support, turns into new resistance. And although we've had a spike through the resistance today, it depends on whether we get a close, I believe, because it's such an important resistance. I think you'd be looking for a close through that resistance. Now, if you start to get a close through that resistance, and for example tomorrow starts trading above 1240 as well, I think you can start to believe that this rally that we're seeing in gold is something more than a bear market rally. I think that 1240 spot 60 resistance is incredibly important here in the medium term. And if you broke above there, you'd be looking initially towards 1260 and then ultimately back towards this collection of old lows, which is now the resistance at 1280 as well. So it'd be very important to see where gold closes tonight. It's actually 1239 at the moment, so it's still giving a good old go. But these momentum indicators have unwound now, and certainly the stochastics and the RSI back towards levels at which, if you start to see gold failing at that 1240, which it would, I suppose, have to tonight and then tomorrow, then within this whole bear phase that we've had over the past few months, this is where the RSI got back to in August. So if this is just a bear market rally, then it will be turning lower here, and that would be again quite a strong signal. So That's what we're looking out for. So it's sort of 50-50 on gold at the moment. So you're looking for a close above 1240 spot 60 tonight, and continued upside tomorrow. Okay. I know a lot of you look at oil, actually. What is oil? Oil is Brent crude. Let's just do that. Interesting. Look at that. I'd not even thought of that. Wow. Massive intraday rebound on oil. So finally. Little bull hammer, maybe. Maybe. Obviously, we haven't closed there yet, but it's something to be aware of. After this huge downside, we've got the RSI hugely oversold. So the fact is that at some stage there is going to be a rebound in the oil price. I mean, for example, it's just fallen from this is Brent. It's fallen from 90 above 96, 90 was that 97? Wow, 97.80 down to 84. So it's sort of $14, sort of 15% in the course of 2 weeks. Now that's just incredible move to the downside, but it then opens up the possibility of a sharp snapback rally, and you've had the possibility of that, I believe, maybe in this hammer, but obviously we haven't closed there yet. This dollar weakness that we've seen today could well trigger it, but yeah, that is a fairly strong rebound intraday. Let's see if it rebounds. But yeah, I mean, the oil price at the moment has just been absolutely just killed. That's incredible. That's sort of, I mean, it is the lowest since November 2010. So at some stage, I mean, you look at how history does it. Well, you get these strong downside moves. At some stage, I mean, through that big sell-off, everyone was thinking, well, gold's going to go through the floor and just never stop. Well, obviously it does stop at some stage, and subsequently you get a fairly sharp rebound. So I think, again, this downside in oil, at some stage you're going to get the mother of all rebounds, I believe, and that could happen. It could happen. So you've got a bull hammer forming on oil today, potentially. Okay, so let's go back to FTSE. Wow, that's such a big move to the downside. FTSE did not like the retail sales number from the States. Oh dear. I mean, FTSE has basically, I say basically, been trading sideways for, what, 18 months? It's actually not, that's interesting. Bit of support there, potentially coming in. But obviously the key low is that low that we got back at around just above 6,000, 6,023. But again, on FTSE, at some stage, unless, I mean, this is unless the bottom is going to fall out of the whole world in terms of assets, then at some stage you could imagine FTSE is going to have some sort of a rebound. And you're now sort of thinking, well, okay, I'm not gonna try and catch a falling knife. However, I'm going to be aware that at some stage it's going to start to rally, and I want to be prepared for it. Now, what are you looking out for? I suppose you've got your oversold RSI, potential for a bullish divergence on the RSI as well. Still, I mean, that low on the RSI is 21.5. We're at 24.5, so there is still the potential for bullish divergence. Stochastic sort of settling a little bit, but still, it's a bit of a risky buy if you bought that on a crossover. MACD line's not really showing you any real positivity, so not a huge amount there. And as I said on the Bollinger Bands earlier that we talked about, those Bollinger Bands look pretty horrendous. So yeah, it still looks pretty bad. But you've got to be aware that at some stage, there should, I mean, and I stress this again, at some stage, unless unless there's going to be some sort of absolutely cataclysmic sell-off at some stage. The FTSE is going to have to form some sort of support and rally. DAX, similar sort of story really with the DAX, although I sort of, if anyone reads my strategy report I did at the weekend, it's a big head and shoulders top on DAX, which is a major concern now, considering the selling pressure that we've seen. So that big head and shoulders top now becomes the basis of resistance. Actually, the key low of that is 89.03, so that is the resistance. I don't know why that says. Don't know why that says that. Anyway, so yeah, the DAX has completed this massive head and shoulders top. So what are you looking at in terms of your support? Well, you'd come in there. Oh, this has been just wiped out, hasn't it? Looking at around the 8,500 level now, really, for the support. And even then, yeah, well, I suppose at 8,500 there was a, yeah, back from May 13. That's pretty reasonable. 8,500 around there. It's not too bad. So again, at some stage, we're going to be looking out for a rebound. I mean, stochastics are obviously incredibly weak. MACD lines incredibly weak. RSI still falling. So even, I mean, there's no real prospects at the moment, unless you're going to sort of get some sort of sharp V-shaped bottom on the indicators. It doesn't look great on the DAX. So there we go. Is there anything else you want to look at? Well, SPX. Let's have a look at that. Again, the S&P 500, that fall below 1900 on the S&P, arguably completed a top pattern that gives you, let's measure that from your top there, so 91. So it's, say for example you measured that from 990, sort of 1990 down to 1900, so that gives you 1810 as a downside target from that top pattern. 1840 already. There you go, 1810. That's an old resistance at 1815. Becomes new support. So yeah, that's not a million miles away from where you could see the S&P 500. But the thing that concerns me with the S&P is that, I mean, we're not on log here at the moment, annoyingly. For some reason I can't change it, I don't know why. Anyway, the thing that worries me about the S&P 500 is that we've broken this big primary uptrend. Big primary uptrend broken on the S&P 500. Now, if you drag it back a little bit further, you can make a new uptrend. Oh God, what's happened there? There you go. And you're actually not far off the bottom on that. But this is, I stress, this is not log scale, which theoretically, if you're going to do long-term charts, you should be using log scale, certainly on indices anyway. And S&P 500, there you go. RSI oversold, below 30. Doesn't tend to go below 30, does it? Look at that. February, a little bit of August, you could argue, but now it's below 30. MACD line is negative, stochastics negative. Oh dear, doesn't look good, does it? Yeah, you could well see it back towards that 1815 mark, which is that reaction low that we had in April. Not a million miles off it now. So yeah, I mean, this selling pressure is fairly significant. What I will show you is, if I can find the proper chart. There you go. Here we go. One of my favourite charts at the moment. Although the VIX has just gone through the roof again, 14%. So, okay, look at these spikes on the VIX. every time we get a spike that subsequently corrects, and I stress that, subsequently corrects, you get a key low on the VIX. Now, the concern I suppose you'd have with this chart is whether we're entering into a new phase, but it's still, I mean, look at that, 2011. I mean, that was when the debt ceiling was going on and everyone was just going mental in the States. Yeah, I mean, that is a big move on the VIX, no doubt about it. 26 now, back up 14% on the day. But you are still need to be mindful of that all these spike highs on the VIX coincide with key market lows. So if the VIX does start to come off consistently, then maybe we're in the process of seeing a key low on the VIX. A key low in the markets, i.e. S&P 500. So something worth about. Anyway, right, okay, on that note, I think that's enough for today. And I wish you good luck in all your trading. You've got a PDF on the website that I believe is pretty good, hopefully fairly helpful for your a bit of a summary and as a guide. Next week, in fact, I'm only doing it on next Wednesday actually, so 7 days time. We're going to be talking about Fibonacci, which is all about supports and resistances and potential targets. So yeah, and what we're doing at the moment, we're still running our trader contest on our platform, which if you went to the website and you can still sign up and take part, the winner gets $10,000 in a trading account, and you can still take part until Sunday, which is good. Well, put it so I know a lot of people have signed up and are already playing it, so you best be quick. But anyway, my Twitter handle, if you want to engage me on Twitter, is @HantecRich. And any further questions or feedback, comments, come to marketing@hantecfx.com. And on that note, I will leave you with my risk warning, and I will wish you good luck in your trading, and I will speak to you next week for Fibonacci. Thank you very much.